Welcome to Iron Financial, the only place dedicated to helping you forge a stronger portfolio and cut through all the weakness in the market. I'm your lead analyst, and today we are putting Worthington Enterprises, that's ticker WOR, under the microscope. Now, on the surface, their latest report looked like a solid piece of work. They beat expectations. But the market? Well, the market reacted by sending the stock lower. So today, we're going to grab our tools, break this thing down, and figure out the disconnect between that glossy press release and the market's cold, hard verdict. Right, so let's start with the central paradox here. You've got a company, Worthington, that comes out and smashes revenue estimates. Sales are up over 24%. The CEO is out there talking about a strong, resilient performance. You'd think the stock would pop, right? But it didn't. It dropped 2.34% after the news hit. Now, hold on a second. That just doesn't add up. A beat is supposed to be good news. So what's going on? It tells me the market is seeing something that isn't in the headlines. You got to remember, the market is always looking ahead. It's not just reacting to yesterday's numbers, it's stress testing the foundation for tomorrow. A drop like this, after what looks like a win, it's a huge red flag. It means investors are looking at this company's financial structure and seeing some serious cracks. Exactly. So to figure out what those cracks are, we're going to conduct our own structural analysis. Think of this as our blueprint for today. First, we're going to tackle that earnings paradox head-on. Then we're going to deconstruct their revenue growth. Where did it really come from? From there, we'll inspect the balance sheet for any fractures, and believe me, we think we found some. Then we'll analyze the pressure on their profit margins. After that, we follow the real story, the smart money. Who's staying, and more importantly, who is getting out. And finally, we'll hammer out a verdict. Is this company a solid frame for your portfolio, or is it just a pretty facade? All right, let's get into it. Part 1, the earnings paradox. We're going to start by looking at the surface. You know, the numbers that the company flashes in front of you. This is the shiny facade they present to the world. And you have to admit, on paper, it looks pretty darn impressive. And here they are. The headline numbers look great. Adjusted earnings per share came in at 98 cents. The estimate was 96 cents. So a nice little beat there. But look at the revenue. Whoa! They reported $378.7 million when the street was only looking for about $349 million. That's not just a beat. That's a blowout. If you were just a headline trader, you'd see this and think, this is a fortress. You'd expect the stock to soar. It's a clear sign of a well-built, resilient company, or so it seems. And then you get the cherry on top from the CEO, Joe Hayek. He says we delivered another quarter of strong, resilient performance, and on and on. He's painting a picture of flawless execution, of a company that just keeps winning. But hang on. Executive confidence is fine. It's part of the job. But it's just words. The market's reaction, that's action. And the action was to sell. So the market heard this quote, it saw the big revenue beat, and it still hit the sell button. That tells you the real story isn't in the CEO's carefully crafted statement. It's buried somewhere deep in the financials. The market, it seems, isn't buying this shiny facade. And that is exactly where we're going next. It's time to look past that fresh coat of paint and get under the hood. For our second section, we're going to deconstruct that incredible 24% sales growth figure. We need to find out where it actually came from. Was this growth built through hard work and operational excellence, or was it just bought and paid for? And here it is. This is the first major crack we're seeing in that facade. The company reports this massive 24.4% year-over-year jump in net sales, an incredible number. But look at the number on the right. That's the one that matters. When you strip out all the companies they just bought, their actual organic sales growth, from their core business, was only 13.8%. Now, don't get me wrong, 13.8% is still a solid number, but it's a long way from the 24.4% they're shouting about in the headline. A massive piece of that growth wasn't earned, it was purchased. This is what we call growth by acquisition, and it tells a totally different story about the true health of the company. Let's put some hard numbers on that. So, the total sales increase was $74.2 million. Of that, a full $32.2 million, that's about 43% of the total increase, came from the companies they just bought. The core business, the part they've been running all along, was only responsible for the other $42 million. So this forces a critical question for any investor looking at the stock. Is this sustainable? Are they just buying revenue to mask weakness in their main business? Look, there's a huge difference between a smart, strategic acquisition and just paying for growth because you can't build it yourself. Is this a sign of a strong company expanding its empire, or is it a company using acquisitions like Spackle to patch over cracks in the wall? And that question about the quality of their revenue leads us right to the next big problem, the cost of that acquired growth.
This is where we stop looking at the shiny exterior and start pressure testing the foundation itself. Let's move to Section 3, the balance sheet fracture. And this, my friends, is where we find the first real, dangerous cracks in Worthington's entire financial structure. Okay, just look at this chart. This shows you the price they paid for that growth, and it is absolutely staggering. On May 31st of last year, Worthington was sitting on a mountain of cash, $250 million. Now look at the end of this last quarter. That position has completely collapsed to just $6 million. Wait. That is not a decline. That's a cash bonfire. They torched 97% of their cash reserves in less than a year. From a risk perspective, this is a 5-alarm fire. This company went from having this massive financial cushion to weather any storm, any recession, to having basically nothing in the bank. This isn't just a crack. This is a potential sinkhole opening up right under the foundation.
And where did it all go? Well, the cash was spent mostly on 2 acquisitions, the big one being the $205 million purchase of LSI Group. This was the fuel for that top-line revenue growth we saw earlier. What they did, effectively, was they converted cash on their balance sheet into revenue on their income statement. But in doing so, they have fundamentally changed their entire risk profile. They traded their financial safety net for a bigger revenue number. They went from being a cash-rich, stable company to one that is now completely dependent on these new, unproven assets. They have levered up their risk in a massive, massive way. And that's not even the whole story. It gets worse. While all that cash was flying out the door, liabilities were flooding in. Their total liabilities are up over 10% year over year. They've climbed from around $744 million to $821 million. And their total debt now stands at $312 million. So let me get this straight. They incinerated their cash reserves while at the same time taking on more debt and more liabilities. You have to ask the question, how is that building a stronger company? They've traded a fortress-like balance sheet for a bigger, more indebted, and frankly, a much more fragile structure.
That is the multi-million-dollar question, isn't it? The balance sheet is clearly stressed to the breaking point. So now we have to ask, is the company they've built with all these acquisitions actually more profitable? Is this new, larger framework stronger, or are these new parts actually weakening the integrity of the whole structure? Let's move on to Section 4 and examine the pressure on their profit margins. This table tells a really critical story. Let's start at the bottom. The company's overall consolidated adjusted EBITDA margin has eroded. It fell from 24.2% down to 22.3%. So, despite that big jump in revenue, the company is now less profitable for every dollar of sales. But the real story, the smoking gun, is in the building products segment. That's the very segment where the new acquisitions are. Its margins absolutely cratered, falling from 32.3% all the way down to 26.3%. This is a massive drop. They spent $250 million to buy growth in a segment where their profitability is getting crushed. This just screams poor capital allocation. They paid a premium for assets that are immediately dragging down the entire company's profitability. And right here, this is the proof. This slide just hammers the point home. Their cost of goods sold, that's what it costs them to actually make and sell their products, jumped by nearly 35%. That is growing significantly faster than their revenue growth of 24%. This is what we call negative operating leverage, and it is a terrible sign. It means that for every new dollar of sales they bring in, their costs are rising even faster. It's like they're running on a treadmill that's constantly speeding up. They have to run harder and harder just to fall further behind. This is a sign of a business that is under serious, serious pressure. So the financials are telling a story of lower quality revenue, a fractured balance sheet, and eroding margins. But, numbers on a page are one thing. The actions of major investors, the so-called smart money, that can tell an even deeper story. It's a vote of confidence, or in this case, a vote of no confidence in the company's framework. So let's move to Section 5 and do what we do best, follow the money. Okay, the first major move we see is from Macquarie Group. And look, they didn't just trim their position, they didn't rebalance, they sold every single share they owned. A complete liquidation worth nearly $90 million. That's not just portfolio management, that is a statement. When a massive institution like that makes a complete exit, it's a significant vote of no confidence. It means their analysts looked at everything we just looked at and they decided to hit the big red eject button. And they were not the only ones. Hotchkiss & Wiley Capital Management, another significant holder, followed the exact same playbook. They completely liquidated their position, dumping over $10 million worth of stock onto the market. You're starting to see a very clear pattern here. The big money managers are not just getting nervous, they are heading for the exit as fast as they can. And look at this one. This is Renaissance Technologies, one of the most successful quantitative hedge funds on the planet. Even their supercomputer algorithms decided to dump the stock. They sold over 85% of their position. When the quants who rely on nothing but pure, cold, hard data decide it's time to get out, that is a massive red flag. And the broader data backs this up. In the last quarter, 167 institutions decreased their positions, while only 123 added. The tide of big money is clearly and unmistakably flowing out. But this is where the story gets a little more complicated, and you have to pay close attention. While these large institutions are selling by the millions, the people who know the company best, the insiders, the executives in the boardroom, they're doing the exact opposite. In the last 6 months, there have been insider buys and 0 insider sales. This presents a classic market conflict that we have to untangle. Okay, let's break this down. The purchase by John McConnell, 45 shares, that's basically noise. It's an insignificant amount, probably an automatic purchase plan. We can just dismiss that. But the purchase by Michael Endres, a director on the board, that's a whole different story. 10,000 shares for over $500,000 of his own money. Now that is a real, meaningful signal of confidence. That's real skin in the game. So this frames the central debate perfectly. Who do you trust more? The hedge funds and the institutions with their armies of analysts and their sophisticated algorithms? Or the director on the inside who lives and breathes this business every single day? Which brings us to our final section. It's time. We're going to assemble all of this evidence, the good, the bad, and the very ugly, and we're going to deliver our final verdict on the structural integrity of Worthington Enterprises. Let's lay out the final blueprint. All right, let's lay this out. The bull versus the bear. The bull case, what we're calling the shiny facade, it's built on that strong headline revenue growth of 24%. It's built on beating analyst estimates for both EPS and sales. And you've got that significant insider buying showing confidence, plus they do consistently return capital to shareholders. On the surface, it's a very compelling story. But then you have the bear case, which reveals all the deep structural cracks. That growth is low quality, fueled by acquisitions. This led directly to a massive cash burn that incinerated 97% of their reserves, which they replaced with rising debt and liabilities. This new, bigger company is actually less profitable, with eroding margins across the board. And finally, the smart money, the major institutions, are exiting. The market didn't sell off on a whim. It sold off because it looked right past that shiny facade and saw these very dangerous cracks. So, this leaves us with the final critical question you have to ask yourself. After seeing all the evidence, do you believe Worthington's recent moves have built a stronger, more solid foundation for future growth? Or have they simply constructed a much larger, more impressive-looking building on a foundation of sand? The market has already placed its bet. Now you have to decide for yourself. Thanks for joining us here at Iron Financial. Remember, always look beyond the surface and keep forging that portfolio with strength.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.